In 2018, Wolfspeed was hailed as the future of power electronics, a $12 billion darling of the semiconductor world that promised to revolutionize the clean energy era. It was the company behind a technology so advanced that governments called it critical to national security. Silicon carbide, or SiC, was its secret weapon, a material that could make electric vehicles faster, data centers more efficient, and renewable energy systems more powerful. But just 7 years later, that same company filed for bankruptcy. The world's leading silicon carbide pioneer, once at the peak of its industry, collapsed under the weight of its own ambition. Billions were lost, factories stood half-built, and investors were left wondering how the brightest light in the semiconductor world burned out so fast. This is the story of Wolfspeed, how a company that helped create a new technological frontier ended up being destroyed by the very revolution it led. The beginning of a revolution. To understand Wolfspeed's downfall, we have to go back to its beginning, back to 1987 at North Carolina State University. That's where a group of visionary scientists founded a company called Cree Research. Their mission was bold: harness the power of a material that most of the world had written off as too difficult to tame. That material was silicon carbide, a compound known for its incredible hardness and heat resistance. For decades, scientists believed it couldn't be used for commercial electronics. Cree's founders disagreed, and in 1989 they achieved something that changed technology forever: the world's first blue LED. It might sound small today, but that invention made full-color LED displays possible, from digital billboards to modern televisions. More importantly, it introduced silicon carbide to the world, proving that this strange crystal had a future far beyond lighting. By 1991, Cree produced the first commercial silicon carbide wafer, a thin slice of crystal used as the foundation for electronic circuits. It was a breakthrough that would quietly reshape the semiconductor industry. Through the 1990s and 2000s, Cree built its fortune on LED lighting. But behind the scenes, it was perfecting the art of silicon carbide crystal growth. While most companies focused on immediate profits, Cree's engineers worked tirelessly to create purer, larger, and more stable silicon carbide wafers. These wafers were incredibly difficult to manufacture, requiring years of research and immense precision. But Cree understood their potential. Silicon carbide wasn't just another material. It was the foundation for a new generation of high-efficiency electronics. The rise and fall of the LED empire. As Cree's LED business expanded, the company became a global leader in lighting technology. In 2011, it acquired Root Lighting for $525 million, moving from components to full lighting systems. Revenues tripled, and Cree seemed unstoppable. Yet beneath the YOS surface, trouble was brewing. Chinese manufacturers had begun flooding the market with cheaper LED products, using low-cost materials instead of Cree's high-performance silicon carbide. LEDs that were once differentiated by efficiency and quality became commodities sold on price. Cree's margins fell from nearly 50% in 2011 to just 26% by 2018. The business that once powered its success was now dragging it down. Realizing that the LED revolution it had sparked had become a race to the bottom, Cree made a radical decision to sell off its lighting division and focus entirely on its true expertise: silicon carbide. The promise of silicon carbide. In 2019, Cree officially rebranded as Wolfspeed and transformed into the world's only pure-play silicon carbide company. Its mission was to lead the transition from traditional silicon to wide bandgap semiconductors, materials that could handle higher voltages, run hotter, and operate more efficiently. Silicon carbide, unlike silicon, could power the next generation of electric vehicles, renewable energy grids, and AI data centers. It was the key to making electronics smaller, faster, and more energy efficient. Wolfspeed didn't just want to make the wafers, it wanted to dominate every stage of the process. The company became vertically integrated, controlling everything from crystal growth and wafer slicing to packaging and power device fabrication. By 2021, Wolfspeed held over 90% of the global market for high-end silicon carbide substrates. Its wafers were the gold standard for the industry. It supplied giants like STMicro, Infineon, and onsemi, and it seemed like nothing could stop its rise. The billion-dollar bet. But success breeds risk, and Wolfspeed's leadership was about to make a fateful choice. Flush with confidence and backed by government enthusiasm for electrification, Wolfspeed embarked on an aggressive expansion plan. In 2019, it announced a $6.5 billion investment to build two massive new factories, Mohawk Valley Fab in New York, which would produce silicon carbide power devices, and the J.P. Siler City Fab in North Carolina, which would manufacture the new generation of 200mm silicon carbide wafers. The goal was to double wafer size, cut production costs, and create the world's first fully automated silicon carbide manufacturing ecosystem. If it worked, Wolfspeed would lock down its leadership for decades. But this was a massive gamble. It was a plan built on debt, optimism, and one crucial assumption: that global demand for electric vehicles and renewable power would keep growing without pause. The perfect storm. For a while, that assumption held true. EV adoption rates soared in 2021 and 2022. Governments offered generous subsidies and manufacturers rushed to secure silicon carbide supply. Wolfspeed couldn't produce wafers fast enough. To fund its expansion, it raised billions through convertible notes and loans from Apollo Global Management. By 2023, its total debt had ballooned to over $4 billion, but the company's management believed that once its new factories hit 80% utilization, profits would soar, and all the debt would be manageable. The problem? Those factories never reached anywhere close to that level. By 2023, Wolfspeed's Mohawk Valley Fab, its crown jewel, that was operating at only 12% capacity. Every unused machine represented millions of dollars in lost efficiency. Startup costs piled up, and yields on the new 200mm wafers lagged far behind expectations. Instead of scaling up production, Wolfspeed was spending billions just to get its factories running properly. At the same time, the global picture began to shift. Electric vehicle demand slowed dramatically. Governments in the US and Europe cut EV tax incentives, and automakers like GM, Ford, and Volkswagen slashed their production forecasts. The very market Wolfspeed had built its future on was suddenly shrinking. Meanwhile, in China, history was repeating itself. Just as they had done in LEDs, Chinese manufacturers flooded the market with cheaper, lower-quality silicon carbide wafers. Oversupply met weakening demand, and prices fell. Wolfspeed, with its expensive American facilities and massive debt load, was trapped. Its margins turned deeply negative, cash flow evaporated, and investors panicked. By the end of 2024, Wolfspeed was sitting on $6.8 billion in debt and burning through billions in cash every quarter. Its dream of becoming the global silicon carbide champion had turned into a financial nightmare. Desperate measures. In a desperate bid to survive, Wolfspeed sought outside help. It negotiated for $750 million in government funding through the U.S. CHIPS Act, meant to boost domestic semiconductor manufacturing, and another $750 million from Apollo as part of an accordion feature loan. It also expected a $1 billion tax refund from the government. On paper, this $2.5 billion lifeline could have saved the company, but the timing was disastrous. The CHIPS Act commitment was non-binding and conditional on Wolfspeed restructuring its debt first. Then, in early 2025, U.S. political shifts froze the CHIPS Act subsidy program. The government money never arrived. Wolfspeed's liquidity collapsed, and its creditors began circling. By March 2025, the company had less than a year of cash left and was at risk of breaching its debt covenants. Collapse and bankruptcy. As Wolfspeed's finances unraveled, creditors and hedge funds prepared for the inevitable. Attempts to reach an out-of-court deal failed, and Apollo, known for its aggressive loan-to-own strategies, was ready to take control. In June 2025, Wolfspeed signed a restructuring agreement with its major lenders and just days later filed for Chapter 11 bankruptcy. The restructuring erased about 70% of its $6.7 billion debt, bringing total obligations down to $2.1 billion. Senior lenders like Apollo recovered most of their investments, while bondholders received equity in the new company. Japan's Renesas Electronics, one of Wolfspeed's biggest customers, took a $1.7 billion loss, but secured a 39% ownership stake to protect its wafer supply, ensuring Wolfspeed's survival, at least for now. The aftermath. When Wolfspeed emerged from bankruptcy in September 2025, it was leaner but far weaker. Debt remained high, and profitability was still years away. The company promised a turnaround by 2027, yet analysts doubted its projections. Capital spending looked too low, competition from China was intensifying, and production efficiency was still far from ideal. Wolfspeed had survived the storm, but its future remained uncertain. Lessons from the fall: Wolfspeed's story isn't one of fraud, it's one of overreach. The company bet everything on a future that arrived slower than expected, building massive factories before the market was ready. In semiconductors, scale and timing are everything, and Wolfspeed's invest first, scale later strategy proved fatal. Each delay cost millions, each misstep eroded trust, and soon ambition turned into collapse. The lesson is simple. Innovation alone doesn't guarantee success. Disciplined execution does. Wolfspeed's fall reminds us that even industry pioneers can crumble when vision outpaces reality. Today, the company still operates, its technology unmatched, but its scars deep. Once a symbol of America's semiconductor promise, Wolfspeed now stands as a cautionary tale. Proof that in chasing the future too fast, even the brightest lights can burn out.